China and the US trade officials are expected to hold talks coming up soon in London. And guess what? The market is expecting something big here. And the White House senior advisor Hassett says, I'm absolutely expecting progress from the US-China talks. And so is the market. And with the NASDAQ and S&P 500 just a stone's throw away from reaching fresh all-time highs, it is pretty clear that this market does have some pretty high expectations, thinking that the worst is definitely behind us, or at least that's what the market thinks. They think that the worst of the negotiations are behind us, and with China and the US meeting in London, that's a very constructive position. So the market is, like I said, very close to an all-time high. It does look like we are likely to continue to see progress on those deals. However, if you get any surprises to that, that could cause some market volatility. That being said, the path of least resistance, in my opinion, is still to the upside. I think we are likely to set some all-time highs pretty soon here, especially if some deals get announced in the coming days and weeks. But despite the market continuing to make a push higher, we still see above average bearishness in the weekly investor sentiment survey that we often reflect on in this channel. And this has been a really good contrarian indicator as people got very bearish right at the bottom of the market. We can also see the put to call ratio here still relatively elevated, showing people are still nervous and buying puts aggressively in this market, which is again another contrarian bullish indicator that I often reference in my videos. However, it's not all great out there. We did get a good number on NFP, which I'll show you in a second, but inflation this week, which comes out Wednesday, we get the CPI report, is expected to actually tick higher to 2.5%. So we'll see what the number brings. If there is a beat on inflation, meaning we stay at like 2.3% or we even move lower, the market would probably cheer that pretty aggressively, as that would give the Fed more room to likely cut interest rates this year. But like I said, not everything is rosy out there. Take a look at manufacturing PMIs, which missed big last week, suggesting that forward-looking indicators of the manufacturing part of our economy are not looking super great. And services PMI data is not necessarily here to save the day either. We saw a big miss on this number, 49.9, showing contraction for the first time in many months in the forward-looking indicator that is services PMI for our economy. Unemployment claims also ticked higher last week, and what's interesting is that we are also forecasting again for an even higher number, forecasting for 241,000 unemployment claims this coming week, which is really interesting. We'll get that data on Friday. So while I do still like the indices moving higher, and I think that there is more bullish room to go, I'd personally not be looking to add any additional index trades on the long side unless we got a pullback prior to doing so. I think the risk to reward on the S&P 500, the NASDAQ, and all that looks a lot better if you do get a pullback first. So I'm not going to hold my breath. I don't necessarily think this is going to happen, but if it does happen, this would be a more attractive entry point in my view than trying to buy right at current levels. Specifically, I do think that this trade that I've set up here is a really good one in terms of a risk to reward basis, because basically I'd be looking for a pullback into the support level where we found significant buyers previously, and then putting a stop loss below that structure in case it fails. I have the same general bias when it comes to the S&P 500 and the Dow Jones, which is sitting at that key level of resistance currently. This one also could be interesting if you get a breakout here and pull back into that area of support. I like that trade quite a bit for a return to the all-time highs on the Dow Jones. But of the indices recently, I actually like the Russell 2000 quite a bit, and I'm sitting on a pretty good trade here. I've now trailed my stop loss into profit inside of our VIP group and continue to hold on to this winner to see if we can make a bigger push in the small cap index here. This is, of course, small companies in the United States on an index level, and you can see we still have on this index significant ways to go before hitting all-time highs again, which is a 15% move higher. I do think that the Russell this year could actually have a bit of a bounce back. It's significantly underperformed in recent years, but I do think that that is potentially subject to change. While the inflation data has been trending lower, jobs data has been mostly okay. And I think that's an environment where you can get a Goldilocks environment that could favor the Russell's upside. Taking a look at the US dollar, things continue to be range bound here. And while we had that NFP report last week, why didn't NFP give us a bigger bump to the upside for the dollar index? Well, I'll show you that right now. So NFP on Friday came in at 139,000 jobs added to the US economy. That's just a narrow beat compared to the forecasted 126,000. If we scroll down, I want to show you this chart that we've added, which I think is a really useful one for exactly what we just did. Looking at the magnitude of how much NFP beat or missed expectations. And you can see, yes, we beat expectations on Friday, but in no way was it some sort of magical, huge beat relative to forecasts. And, it's not the kind of 91,000 or 92,000 or 107,000 jobs beat that would have really strengthened the US dollar. We didn't quite get that in terms of the data point we saw on Friday. So, again, I think that while this is a beat nonetheless, I don't think it really shocked, the market and didn't cause the dollar index to move too far to the upside. I think that's an appropriate reaction for the US dollar. And I still think that most of our indicators still suggest weakness for the US dollar. Let me show you why. So I briefly mentioned several of our missed economic reports from last week, like PMIs, which both missed expectations negatively. That was a big negative for the US dollar last week, 48.5 and 49.9, both in contraction territory. Remember that under 50 is contraction when it comes to PMI numbers. So the economy is expected by, the people that answer these surveys, which are important people. These are executives that make hiring and firing and sales decisions throughout the economy. They see some contraction coming. So that is something that is forward-looking and interesting to keep an eye on. At the same time, unemployment rate stayed flat, but we had the weekly jobless claims, unemployment claims came in worse than expected. So we saw some contraction there. ADP was a complete miss and a really ugly number last week. So these are things that suggest some weakness for the US dollar at this time. So from a price action perspective, I would not be surprised if this week we did see a break through the lows on the US dollar index, the DXY, but specifically, could it possibly be CPI or PPI that does this for us? If we were to see a cooling data point in inflation, that would suggest more downside on the dollar index in my personal view. If, for example, on CPI, we got a 2.3%, which remember that the forecast is 2.5% for this week. So if we actually got 2.3, that could shoot the dollar lower in my personal view. Today on the live stream, a lot of people asked me about my thoughts on gold, and I am bullish on gold for a number of reasons. But the biggest one I just got done explaining. The dollar index to me looks a little soft right now with some of the economic data prints. So I'd be looking for either a pullback into support here or a breakout through those previous all-time closing highs for an opportunity to look to buy the break and retest. So I do like gold on the long side, and I do have confirmation from the Edge Finder at this time. So if I pull up my top setups page and I look for gold on this list, you can see gold is getting a +6 reading on the Edge Finder. COT data also came in strong. Let's take a quick look at COT. But before we look at the commitment of traders data, let me just remind you guys that this week we are doing our biggest discount of the year for VIP memberships. If you'd like to get notified anytime I take a position in the markets, whether it's an index trade or a Forex trade or a gold trade, every trade that I take gets notified inside of our Discord VIP group. And if that's something that you're interested in, click the first link in the description down below to speak to our support team about getting a membership with us, or click the link in the description down below, a1trading.com/VIP, to explore the VIP membership and see everything that it has to offer. Don't miss the discount. It's the biggest one we do all year long. So in terms of the weekly COT buys and sells, I saw gold on here and I thought this was interesting. So the overall net positioning long to short is still very bullish for gold relative to the short positioning they have. But specifically, I wanted to show you guys this. The change in long contracts week to week was pretty substantially bullish. And the change in short contracts was also bullish because they closed out short positions. When I say they, the ominous they, what I'm referring to is specifically the aggregated COT data for institutional positioning. That's, of course, hedge funds and banks and money managers and things like that. The aggregated decision-making here of institutional money was to add longs and decrease shorts. That's a pretty bullish week over week change. And that puts us in terms of a long-term overall positioning. Gold is still very bullish in the eyes of institutions. If you'd like to use the tool that I'm using to track this data on your own anytime you'd like, you can explore the Edge Finder on our website, a1trading.com/edgefinder, or click the link in the description below to try it for 30 days. It is not a free trial, but if you'd like to try it out, you can find information down below. Taking a look at the euro and the British pound, both of these I am bullish on. I can actually show you also on the Edge Finder. We do currently have some pretty strong readings for both the euro and the British pound. So I'm interested in watching these close. And so I'm going to keep an eye on them specifically for breakouts or pullbacks. So specifically on the euro dollar, if we got this kind of move here this week, I'd be very interested in buying the break and retest of the euro dollar highs or a push down to 111. I would actually be interested in buying that discount as well. So I am bullish on the euro against the US dollar. I'm also bullish on the British pound if we were to get a pullback into this 1.34 level. Dollar yen, I'm pretty mixed on because I'm not particularly bullish on this on the yen either. So just staying flat on this one. The Australian dollar against the US dollar, I do tend to favor the Australian dollar, but would need some pullbacks on this one. These charts are also very choppy here. So if we got something like this, like a more decisive breakout of this consolidation, I may look to get long the Kiwi dollar against the US. And so we'll keep an eye on that. I'm also short euro pound. So far, this trade has gone pretty much nowhere. So nothing really to speak there. CAD Swiss, I'm still long this one. Very, very choppy pair, but collecting positive swaps, holding this currency pair on the long side. So I'll keep holding it. And then NZD JPY, I do have a long position on this one. That's going pretty well so far. I am looking to see if we can get a squeeze higher up into this 89 area of past resistance, at which point I'll probably take some profits on this trade. So I've had a nice trade here on the Kiwi against the Japanese yen. And part of the reason that I've been so bullish on the New Zealand dollar specifically has been the New Zealand Economic Heatmap. So if I pull this up really quick, you can see that most of our indicators for New Zealand are coming in stronger than expectations. Also, sorry for the ugly chart here. I'll check in on why that's happening. But yeah, for the most part, most of our indicators here are still bullish on the New Zealand dollar.
All right, man, let's make a bet. Whoever gets funded first, the other person has to pay him $100.
All right, I'm down.
Sweet. With my new fair value gap, triple witching, timing strategy, you stand no chance.
Okay, I just got funded.
What? How? We just started.
With Maven's new instant funding program, you can get funded for just as little as 19 bucks. They offer some of the best industry pricing, fast payouts, and you can trade pretty much anything on their prop firm. If you'd like to check out Maven's instant funding program, the link and information can be found in the description below. You owe me $100, man.
Come on, man. That's not even fair.
How much more juice do you think this thing has? I mean, we're almost back towards, believe it or not, back to those all-time highs. I'm pretty shocked by it. What are your thoughts?
Yeah, that's probably the likely destination. I mean, at this point, since we didn't really have much of a pullback after that U.S.-China trade agreement gap, I mean, yes, we pulled back to pretty much test it. We didn't fill it. I am thinking that this market just wants to get to all-time highs. I think that it's disappointing to feel like there was very little opportunity to really participate with a technical pullback because even running into major resistance around all those moving averages around I'm talking SPX here, like, 56, 5,700 zone, that US China gap just kind of threw things higher. It's like at that point, the bears just kind of gave up. Yeah. So all we've seen these last few weeks, it's like price really hasn't gone aggressively higher, but it's like every single day you can notice intraday price action is just trying to melt up, trying to melt up, trying to melt up. And, sitting here watching where we're currently at just over 6,000, that was another kind of round number, had a little resistance off it with the Musk and Trump drama last week. Markets don't seem to care. I think just the easiest thing is going to be if we just melt up to the highs, okay, fine. I still think a pullback is likely going to happen. I wouldn't be aggressive at all-time highs. I mean, that's just me. So thoughts on that, Nick? I mean, we could clearly go into a melt up, but there's still a lot of things the market's going to have to digest through the summer. This first kind of 90-day pause through tariffs that'd be in July. Powell, Trump is calling out Powell again for cutting rates. And if more stuff happens with Musk and Trump, who knows? But we don't know, how the negotiations are going for like global tariff conversations. U.S. data, it's all like the same uncertainty is still there. It's just the market just doesn't care anymore. Like right now, the market just doesn't care. So I'm not upset about watching new highs in the portfolio. I'm not. I'm just I saw some of the posts you had last week. I mean, how aggressive are you right now? At all? I mean, just kind of enjoying the melt up? Are you participating actively? I mean, I've tilted, so I mean, I'm seeing some fresh highs. I talked about this last week. If we go to all-time highs, I'm probably going to see like 275 to 280 in the portfolio, which is fine. But I mean, so I've got some bigger plays. Like actually, uranium's been taking off quite a bit for me. Gold and silver are doing pretty well. Silver's had a nice run last week, so those little like holding trades for me are still like generating some juice, but. Yeah. Other than that, it's just kind of swing trading the indexes and trying to stay out of the way and let this melt up happen?
I'm kind of in the same camp. I've got a long position on the Russell right now, which has gone pretty
Okay.
well.
Yep.
IWM, so I'm long IWM. I've got a big basket of tech stocks that I picked up during the sell off, so I've done pretty well on that side. I sold covered calls on several names that I have in the portfolio just with this move. I do think we're getting a little bit stretched, but where I see, to your point, Chris, about maybe just making that move back to the all-time high, what I think is fueling it, what I think gives it more juice, is sentiment is still convinced it's the other way, right? We've
Yeah.
seen, looking at the investor sentiment surveys, we've seen persistent kind of negativity around markets. We're still above historical bearish averages at
We are.
41.4%.
Yep.
Then you take a look at the put to call ratio. Put to call ratio has been still on the upper end. Put demand is still very strong out there.
Hmm.
And so, to me, Chris, I think, while I don't necessarily think that we take out all-time highs and then just it's a forever melt up, I think Trump kind of continues to introduce and keep that volatility somewhere in the back pocket all times.
Right.
I do think that this thing can continue to climb that wall of worry that is so clearly still the case for a lot of sentiment out there. One of the things about 2023, I know you did well in 2023, the bounce back after that big fallout year in 2022.
Hmm.
The big bounce back year was, built on just this pessimism around we're going into a recession and all that. So, we may be seeing a repeat event of just climbing that negative sentiment despite the odds. I think what we have behind us now is like, okay, Trump seems to back down every time things get really real when it comes to tariffs.
Yep.
And I think the market takes that as okay, the Trump put is there. And, the Trump put is there. Fed probably wants to cut interest rates this year. Earnings came in pretty good and sentiment is still negative. I feel like that's a recipe for at least a retest of those highs.